So thank you so much for coming around.
Thank you very much.
So we're talking 5.93 trillion naira in combined earnings in 2024, and we're talking about strategic shifts. I'd like you to tell us more about that story. Let's start from there.
Okay, yeah. So I mean, yeah, last year we saw interest rates correct upwards, and so naturally the banks will move a lot of their portfolios to fixed income securities, and in a high yield environment, that would naturally raise the interest income from these securities.
You talk about high yield environment, but then it was a period where we had a volatile financial landscape. Talking about global tensions, market fluctuations, monetary policy tightenings, austerity measures. Is it that those were not particular issues that were pertinent to the sector?
Okay, so I mean, banks make money from lending, right? So a tight monetary policy means higher interest rates, which translates to higher interest income. So typically the banks do well in such environments when there's a higher level of interest rates, and that happens across globally as well. You could say that the broader economic situation is different when it comes to the banks.
And we saw aggressive expansion in investment portfolios, but then how are they able to balance stable returns with having to manage the risks involved, even though probably those risks were not that monumental as one would have thought?
Yeah, I mean, in terms of managing the risk, I think the banks, they have been able to still balance out with the credit that they extend to the private sector. Generally, in total, we still saw private sector credit to the private sector increase, actually almost double between 2023 and 2024, from 565 to about 900 billion. So there's still appetite from the private sector for debt, and as long as there's demand, supply is always going to be there, right? So the banks, I think they've still been able to balance between the credit to the private sector as well as credit to more investments in treasury bills and bonds.
Okay, so what about future vulnerabilities? I mean, the exposure to interest rate declines, possibly, and of course, talking about slowdown in real sector lending.
Yeah. Okay, so I mean, you have to understand that there's an inverse relationship between yields and the price of these securities, right? So if interest rates should come down, then the price of those securities would go up, right? That's what it would mean. So they would still book price capital appreciation gains anyway, and then within that time too, you probably see them try to shift and lend more a bit to the private sector, to more bilateral loans.
Okay, so permit me to ask, what proportion of the securities held by these banks are actually exposed to potential they mark-to-market losses, probably if the interest rates begin to fall?
Yeah, so to be honest, quite a lot of the banks actually they hold more of the securities as held to maturity. So not a lot of them actually hold them for trading. You'd see, but it's a bit heterogeneous across the banks. You have most of the banks holding maybe about 25 to 30% of their bond portfolios or fixed income portfolios as trading portfolios.
All right, so I won't believe you're aware that the CBN lifted the 2 billion naira daily cap on the standing deposit facility. So I'd like to find out how that helped banks to stay liquid.
Yeah. So I mean, lifting it meant that instead of the banks having or being forced to lend out this money, they could pack it with the CBN. So it also helped smoothen out the interbank lending rates and the disparities that we were seeing previously. It was pretty much a measure to sort of also sap liquidity from the markets, essentially.
So when you look at, I mentioned a couple of banks during my introduction, but then when you look at the banks and how they are performing, let's just narrow it down to 9 or 10 of the top performing banks. Now, which of them would you say are better capitalized to actually withstand any sort of potential volatility or maybe investment asset issues?
Yeah, I mean, I would say that generally because of the CBN recapitalization exercise, like pretty much most of the banks are all, well, better capitalized than they were before. But naturally, the FUGAs are, typically larger and have larger capital buffers, say for First Bank. But generally, I think the banks have generally all sort of raised their capital levels based on the CBN's directive. So they're all pretty resilient at this point.
Yeah, so what about banks with a low capital base? Is there any hope for them? I mean, if we're not talking about mergers, if we're not talking about acquisition, can they still stay resilient?
Yeah, so I mean, the ones with the low capital base, you would probably see there could be some mergers, there could be some acquisitions within that space. But I mean, even for some of them, their assets and liabilities are pretty much relative to their capital. So they're pretty also resilient, I would say, as well, yeah.
All right, so you would agree with me that there are still regulatory hurdles, either with the CBN or other regulatory bodies. There are issues around compliance, most especially for the banks, for some policies that may be harsh on them. There are also issues around tax obligations. Now, for the players, what do you think their priorities should be if they have, of course, basically they have to navigate the hurdles, but then what should be their priorities to actually stay strong amidst all these issues?
So I think right now the priority really is to meet the capital requirements, right, for you to continue to operate. And I think that, amidst that, it's balancing out, your risk asset portfolio to make sure you have the right mix. And particularly given the environment in which we're in right now with, what's happening in the US, which will definitely have its triple effects. We'll probably see global inflation sort of come up again. And, this could pose some systemic shocks around. So I think it's timely as well that these banks have been mandated to raise their capital base. So I think focusing on making sure that they have a very strong capital base should be the top priority, right?
And you think with the global headwinds, the financial sector will be able to scale or probably prevent some sort of security yield crash?
Okay, so I think we've had some pretty dark days over the past few weeks, and quite frankly, I would say Nigeria has fared pretty well. We haven't seen bond yields go crazy. I mean, yes, there have been weaknesses in bond prices, but we've seen the CBN really step in and manage the currency situation. We've not seen it run away. So I think we're in a better position than we were previously, and I think, if not anything, this situation has pretty much shown that. Yeah, that's what I would say. Yeah.
But then when we look at the deadline, even for that recapitalization process, it's 2026. Whether or not these banks have that strong capital base, or there's going to be some sort of funding for it, do you think they will be able to meet that deadline, both for those who are actually performing well and those who are not strong enough?
Yeah, I think most of the banks, actually, particularly the larger banks, they've pretty much, some of them have already met it. For those who haven't, they have a little bit more to go. I think UBA is about to come out with another public offer. And, I think there's definitely still demand. I think there is the economy, or the Nigerian economy, is showing signs of recovery, and foreign investors are taking note. So yeah, I think that they will be able to meet the deadlines. The smaller banks who may not be able to meet those deadlines, they may also have to, they may explore acquisitions or merger opportunities. So yeah, I think the deadline is still very much in play. I think the banks are still on track to meet the deadline.
All right, let's look at other peculiarities now. What risk management strategies are banks deploying as of now to balance returns from what we understand as fair value through other comprehensive income and fair value through profits or loss assets?
So yeah, like I mentioned earlier, actually, you'd find that most of the banks actually are holding a lot of these securities to maturity. So you'd see that in the balance sheet section where you have the fair value or other income or profit and loss. You'd see that very small portion of their debt securities portfolio is actually within that band, usually below 30%.
All right. So are you hoping that there'll be some sort of more diversification in bank security portfolios across different assets. I mean, talking about sovereign, corporate bonds, so to speak.
Yeah, I mean, the banks are largely heavy on the sovereign bonds, to be honest. I think very few banks have a bit of, diversity when it comes to that. But, the sovereign bond market is much more liquid. So a lot of them would typically stick to the sovereign bonds. Yeah.
All right, so let's tie all these around to how it is affecting small businesses, business holders, and even households. Of course, we know that every time they need money, either for personal purchases or for expansion, so to speak, they get to go to the banks for loans. So how do you think this is helping out? Most especially when we talk about the interest rates and what they can access in terms of funds.
Okay, yeah. I mean, I would separate businesses from individuals, but for businesses, I mean, interestingly, as much as we've seen the interest rates go up, we've also seen a lot of people still come to the market to raise, even from the debt capital markets, to raise capital at those interest rates. That just shows you that a lot of businesses in Nigeria typically operate with high margins and so can typically afford to still pay these higher levels of interest rates. I mean, again, like I said, total credit to private sector, we saw pretty much still doubled in 2024. And I think because of the devaluation that we've seen, a lot of businesses need more naira than they would have needed before anyway to carry out the same level of business. So we've seen those. So we've seen that happen. So we don't see that crowding out effect as such as we would have typically forecasted to happen. The data doesn't show that that's what has happened. In fact, even between Q4 and Q1 this year, we're still seeing credit to the private sector remain pretty much stable, even marginally increasing actually. So yeah, but on the retail side or on the more consumer side, I think, the banks, obviously higher interest rates would make people, discourage people from borrowing. But I think Nigeria, we have quite a high risk appetite. You still find people go and lend at ridiculous rates anyway. So yeah, the data hasn't shown any level of slowdown or pushback from businesses or retail customers.
All right. Well, we hope that that strength can be consolidated with a few other probably initiatives making more robust in the coming years. Dr. Anosi Ikimalo, MD CEO, Optimum Global. Thank you so much for your time.
Thank you very much.
Edge. It was nice having you around.
Thank you.